A $70 billion hedge fund just dropped a bombshell that could shatter the AI dream. The tech world darlings are in their crosshairs, and the fallout could be massive. Felix here, and this is my chief financial advisor, Winston, who's got a nose for sniffing out market-moving news. And today we're going to dive into a story that could reshape the entire 2024 and the AI rally. But first, let me share something really exciting with you, and that's we're up 80% so far this year on our teaching portfolio. That's a $24,000 gain on a $30,000 portfolio. And you're curious how we did that? Well, I'm hosting a free live trading training for beginners on Tuesday. All you got to do is grab yourself a free seat. Links down below in the description, felixprehn.org/webinar. Now let's get back to our news story here. Elliott Management, a hedge fund managing a staggering $70 billion, has just fired a warning shot that is echoing through Wall Street. They're claiming that Nvidia, the company at the heart of the AI revolution, is officially in a bubble, and that's not all. They're going further, saying that AI itself is overhyped. Now, you might be saying, I don't care about the hedgies, they're wrong all the time. Well, this fund is a little different. Paul Singer founded it in 1977, and they built a reputation for being sharper than anybody out there. And when they speak, we do listen. And you might be thinking, Felix, have you lost the plot? Nvidia stock's been skyrocketing, and yeah, it's dropping down a little bit, but who cares? And you could be right. But it is up over 100% this year alone, over 600% since the start of last year. And the plot thickens a little bit with that. Elliott, a fund that's only ever lost money in 2 years since the inception of that fund, saying they're skeptical that big tech companies will keep buying Nvidia graphic processing units, short GPU, at the current rate. And let me tell you why. Well, GPUs are basically specialized chips that excel at lots of processing in parallel, making them ideal for AI tasks. And they're basically the workhorse behind the sort of OpenAI and the LLMs and ChatGPT and everything else. So companies like Microsoft, Meta, and Amazon, they've been pouring billions into their AI infrastructure and into pockets of Nvidia shareholders. In fact, Nvidia's data center revenue, which includes sales of AI chips, more than tripled to $10 billion in the second quarter. But Elliott is raising some serious questions about the sustainability of this gold rush. They're not just questioning Nvidia's valuation, they're casting doubt on the entire AI hype machine. According to Elliott, many of AI's supposed applications are never going to be cost effective. They're never actually going to work right. They will take up too much energy, and they'll prove to be untrustworthy, which is a pretty damning indictment from one of the sharpest minds in finance, given that Wall Street's also pouring billions into AI trading. But there is more to unpack here. They're saying AI has failed to deliver on its promised productivity boost. They argued that there are few real uses for AI beyond summarizing notes of meetings, generating reports, and helping with computer coding. Not exactly the world-changing revolution we've been promised. Now, I can always hear you asking, but Felix, surely Nvidia has a plan B. Well, it gets a little bit more tricky here. Many of Nvidia's biggest clients are actually designing their own rival chips. It's like inviting a master chef to your house, learning all their secrets, and then opening your own restaurant next door. Let's put it into perspective. At its peak in late June, Nvidia briefly became the world's largest company with a market cap of $3.3 trillion. But since then, it's dropped off, 20% plus? And Wall Street started to question the sustainability of that AI investment then. Now, Winston is getting a little interested here with this story. He has a pretty good sense for the market and when it shifts. And if you know what Winston knows about Elliott Management, they have a track record that would make most investors green with envy. They've only ever lost money in 2 calendar years since their launch in 1977. That is why we pay attention to these guys. So what could burst the bubble? Elliott suggests it might happen if Nvidia reports slightly poorer numbers and breaks the spell. It's like the emperor's new clothes. Once someone points out the emperor is naked, everyone suddenly sees it. Now, I'm not saying we're heading for a tech crash like we saw in 2000, but it's worth remembering that even the mightiest giants can fall. Just ask anyone who was invested in pets.com or Webvan during the dot-com bubble. And who gobbled up the kind of businesses of pets.com? Amazon. Amazon has a history of inviting in partnerships and then completely disemboweling that partner and running the business themselves. They are also doing the same with AI chip investments. But let's go even deeper, because I think surface level stuff only gets us so far. We always want to figure out, well, how do we benefit from this? So Elliott isn't saying that AI is useless, but they're questioning whether it can live up to the astronomical expectations that have been set. Many analysts predict the global AI market will reach $2 trillion or something like that by 2030. That would be an annual compound growth rate of 37%. But Elliott is suggesting that these might be overly optimistic. Take chatbots. They've certainly improved, but how many times have you found yourself frustrated trying to get a straight answer from a chatbot? AI has, as I say, improved, but it's not the solution it's been made out to be for everything, at least not in this time frame. And then there is the energy issue. Training large AI models requires enormous amounts of computing power, which in turn consumes vast amounts of energy. A single training run for a large language model can emit as much CO2 as 5 cars over their entire lifetime. Is that sustainable in the long run? And let's not forget about competition. While Nvidia dominates the AI chip market, I completely agree with that, competitors still aren't standing still. AMD is ramping up its AI chip production, and even Intel, despite its present struggles, is investing heavily in AI capabilities, not least with US taxpayer money. And while Nvidia holds 80% of the market for AI chips, as the competition heats up, can they maintain that dominance? And what happens to their sky-high valuations if other people are putting out chips that are just cheaper? Margins might get squeezed, right? So what does this teach us investors? Well, it's a reminder that even in the most hyped up sectors, it's crucial to do your due diligence. Don't just follow the crowd. Think critically about the long-term viability of the companies you're investing in. And remember, there is no shame in ever taking profits. That's what I do as a trader, although I have two minds. One is the long-term investor who buys stocks every week, although this is probably the first Monday in years that I haven't been buying stocks because I think things could get a little bit more sour. But if you remember that the stock market isn't a get-rich-quick scheme, it's about building wealth over time through smart and informed decisions, then diversification should be part of that. So yes, tech stocks are brilliant, but some of them come with particularly high risks. And this is exactly why Winston and I spent a couple of hours every week analyzing market trends, company financials, economic indicators, and so on, so that we have better strategies and we are better informed than most people out there. And that's why we're up 80% so far in our teaching portfolio this year even. And are we going to do any trading this week? Probably not. Why? Because it's just kind of crazy out there right now. Nobody quite knows which way the wind's going to blow. And in scenarios like that, you have a lot of risk, not that much potential gain. So what do? We sit on the beach and enjoy ourselves. So if you want to learn those strategies that we implement, then come and join Winston and I at felixfriends.org/webinar. It's Tuesday morning, New York time. It's completely free of charge. And I want to thank you for tuning in. This is Felix and Winston signing off. Felix here. If you're worried about how far this market's going to crash and what's going to happen to your favorite tech stocks next week, then this is the video for you. We're going to run through Nvidia, the S&P, the Nasdaq, Palantir, Apple, Tesla, Microsoft, Neo, Alphabet, Amazon, Meta, PayPal, SoFi, maybe one or two other names we can think of along the way.